Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxes. This episode is on depreciation. Depreciation is the process of allocating the cost of a tangible asset over its useful life. This makes sense unless you're talking about an appreciating asset, and that's a whole different issue. Today, I want to cover 5 main areas and how they work. Section 168, bonus depreciation, Section 179, depreciation, 200% declining balance method, and mid-quarter convention and half-year convention. What is bonus depreciation? Bonus depreciation is a tax incentive that allows a business to immediately deduct 100% of the purchase price of an eligible asset, such as furniture, fixtures, computers, equipment, and machinery, rather than write it off over its useful life. Basically, any maker's property with a recovery period of 20 years or less. The Tax Cuts and Jobs Act of 2017 made major changes to the rules on bonus depreciation. Most significantly, it doubled the bonus depreciation deduction from 50% to 100%. The law also extended Section 168 to cover used property under certain conditions. Prior to that, it only applied to property placed in service that was purchased brand new. The new rules apply to property acquired and placed in service after September 27, 2017, and before January 1st, 2023, at which time the provision will expire unless Congress renews it. In 2023, the rate for bonus depreciation is scheduled to be 80%. In 2024, it will be 60%. In 2025, it will be 40%. And in 2026, it will be 20%. Why use bonus depreciation? When bonus depreciation is taken under Section 179, you must recapture depreciation when business use falls below 50%. That's not the case with Section 168 bonus depreciation. You aren't required to recapture until the asset is sold. Use this as a tax planning strategy. Another benefit to 168 bonus is it can create a net operating loss. What about Section 179? We should all be familiar with Section 179, and it's often used as a verb. We're going to Section 179 that truck. Section 179 allows you to take an immediate deduction for the business expense related to depreciable assets, but it has a few rules that we need to consider. Section 179 has limits. Up to $1,080,000 can be written off using Section 179, and that only applies if the new assets purchased are less than $2,700,000. If the new assets exceed that amount, the 179 limits start to phase in. These are the 2022 amounts. Section 179 can only reduce your income to zero. If you have a $10,000 net profit and have a $20,000 asset, you can take Section 179 on all of it, and it will reduce your income to zero, and $10,000 will be suspended until next year. This may be a beneficial strategy to reduce taxable income during the startup phase of a business. When business use drops below 50%, excess depreciation must be recaptured. If you have a client that frequently moves from employed to self-employed, maybe 179 isn't the best idea. What about 200% declining balance, also known as the double declining balance? The 200% method is the standard used under makers. By using this method, you are taking a depreciation expense over the useful life of the asset, with the largest portion of the deduction being front-loaded. Basically, you take the book balance of the asset at the beginning of the period, do some math, and multiply the result by 200%. Before we get into the math, we need to discuss the mid-quarter and half-year conventions. Now keep this in mind as I define these two methods. Prior to modern bookkeeping software, all accounting was done on ledgers by hand, so convenience would have been a necessity. What is a mid-quarter convention? The mid-quarter convention states that all fixed assets are assumed to have been placed in service in the middle of the quarter, regardless of the actual date. This exists so the first quarter of depreciation is always a half, rather than 23 days or 68 days. And what is the half-year convention? The half-year convention states that all fixed assets are placed in service mid-year, regardless of the actual date. This method exists so the first year depreciation is always 1/2 a year rather than any other number of days or months. Now, which method do you use? If you placed assets in service between January and September, you must use the half-year convention unless 40% or more of the assets are placed in service during the last quarter. Then you're required to use the mid-quarter convention. Now let's get back to the math. Let's start with the easy one, the half year. The formula is pretty simple once you know what you're looking for. Take the cost or basis of the asset, divide by the number of years of depreciation or the useful life, multiply by 1/2, then multiply by 200%. Remember, when using the half-year convention, assets are assumed to have been purchased and placed in service in the middle of the year, regardless of the actual date. Let's take a $2,000 desk, which is 7-year property. We'll start off by taking $2,000, dividing by 7 years, then multiplying by the half year, and then multiplying that by 200%. And in the first year, we have $286 of depreciation. In year number 2, we're going to start with our adjusted basis, and we no longer have to worry about the half year since we are doing a full year's depreciation. Our adjusted basis, $2,000 minus $286 of depreciation already taken, gives us an adjusted basis of $1,714. Divide that by 7 years, multiply that by 200%, and our second year depreciation is $490. Year number 3, $2,000 minus $776 of depreciation taken equals $1,224. Divided by 7 years, multiply that by 200%, and our third year depreciation is $350. You'll need to refer to the depreciation tables as the formula changes after the first few years, but this will get you going in the right direction, especially in the first year or two. Now, let's look at the mid-quarter. Remember, when using the mid-quarter convention, assets are assumed to have been placed in service in the middle of the quarter, regardless of the actual date. First, we need to know which quarter the asset was placed into service, and then apply our first round of math. An asset placed in service in the first quarter of the year would be deemed to have been used 3.5 out of 4 quarters, or 3.5 divided by 4. An asset placed in service in the second quarter would be deemed to have been used 2.5 out of 4 quarters, or 2.5 divided by 4. An asset placed in service in the third quarter would be deemed to have been used 1.5 out of 4 quarters, or 1.5 divided by 4. And an asset placed in service in the fourth quarter would be deemed to have been used 0.5 out of 4 quarters, or 0.5 divided by 4. So our first quarter multiplier is 87.5%. Our second quarter multiplier is 62.5%. Third quarter, 37.5%. And our fourth quarter is 12.5%. Now on to the rest of our formula. You take the basis of the asset, divide by the number of years of service, multiply by 200%, then multiply by the quarterly percentage that we just discussed. A $2,700 computer being depreciated under the mid-quarter method that was purchased in January would be $2,700 divided by 5 years, multiplied by 200%, multiplied by 87.5%, and our first year depreciation would be $945. Year number 2, we're going to take our adjusted basis to start, $2,700 minus $945 depreciation already taken, gives us an adjusted basis of $1,755. Divide by 5 years, multiply by 200%, and our second year depreciation is 702%. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series, and give us a like on Facebook at facebook.com/potentialcpe and on Instagram at instagram.com/potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% of each hour on procedure with real-life examples to walk you through completing the necessary forms to increase your potential.